Good afternoon. So what I'd like to do is to start off by making a prediction. I might nestle within it a bit of a challenge for us InsurTech companies. I'd like to pivot from there to a question that I'll throw out there, and then park it, tell you a little bit about how we at Lemonade think about the challenges that face us. I'd like to indoctrinate you into some of our thinking, share with you some of our experiences, and then perhaps come full circle towards the end and try and answer or give you my answer to the question that I'm going to be posing. So I said I'm going to start off with a prediction. The brands that dominate today dominated during the era of the horse-drawn carriage. There's been tremendous longevity, and the question, or the prediction I'm going to make, if you like, is whether those same brands are going to dominate a generation from now. Are we the last people to be able to say the sentence that I did, that the brands that dominate today dominated during the era of the horse-drawn carriage? And I think the odds are that yes, we are. I think that what we're going to be experiencing in the coming years is a significant changing of the guards. And I'd like to add a bit of color to that. But my prediction is that the brands of tomorrow already exist. They may have already presented on this stage. And that we're going to see a very significant, perhaps not sudden, but very significant shift. And I'll try and come back to this theme at the end, but the underlying reason that I say that is that the assets that insurance companies have built up over these last 100+ years are now revealing themselves to be liabilities. Whether it's their brand, whether it's the distribution methodology, whether it's the IT stack, whether it's the corporate culture, all of these have served them so very well, but the tides are changing. And I think the companies of tomorrow are going to be natively digital. They're going to be created on a substrate that is data by its very foundation. And as I put it playfully, they'll be staffed by bots, not brokers, by AI, not by actuaries. And I think that this is a bit of a challenge to some of the InsurTechs, ourselves included, which is to go for gold, to look at the big prize, not simply to sell tools to existing companies, but to look at the fact that companies that succeed in this place, that become the brands of tomorrow, perhaps have the promise of 100 or 200 years of dominance and very, very sizable business. How will this play out? What shape will it take? I like to phrase this as a question of, are we facing a Wikipedia moment? So Encyclopedia Britannica started in the 1700s, roughly the same time in the same place as Lloyd's of London. And they both did very well under trying circumstances. They weathered the Napoleonic Wars and the Revolutionary Wars and 2 world wars and the Spanish flu. Until in 2010, Britannica encountered a website. And that was just too much. And Britannica folded, and it, of course, doesn't exist anymore. Britannica brought out 15 editions over its 2.5 centuries. Wikipedia updates 10 times a second. It has 30 times more content just in English, not to mention all the other languages. And it doesn't cost $1,000. It's absolutely free, and it's searchable and pocketable, and its advantages are very clear. And the question that I'll leave hovering out there as I meander through the journey of Lemonade a bit is our industry, is the insurance industry facing its own Wikipedia moment? I'll let that one linger, and I'll switch gears for a minute. And I'd like to tell you a little bit about how, as I say, I want to indoctrinate you a little bit into how we think about the challenges that we face as an industry, and then a little bit about how we are trying to solve them and how those attempts have been received during our short time in the market. And to do that, I'm going to travel with you back in time. We're going to start not in the 1700s, but in the 1300s. And I'd like to start this off with Francesco. Francesco is writing a letter to his wife in the 14th century in Florence, and he's complaining about insurance companies. And what Francesco writes is, it is sweet to them to take the monies, but when disaster comes, it is otherwise. Each man draws his rump back and strives not to pay. Now, I confess I don't know exactly what that means, but I don't think it's a compliment. Unless you think that, well, this was a long time ago, times have changed, I'll take you 700 years forward in time to the Urban Dictionary, the crowdsourced dictionary that defines terms, and we'll look up the term insurance, which since 2008 has been defined thus: a business that involves selling people promises to pay later that are never fulfilled. Channeling Francesco just in a more contemporary language. And for good measure, the Urban Dictionary adds the usage of the word, as good dictionaries always do. Goma paid flood insurance premiums for years, but the insurer decided to go out of business when the flood came because management had spent all the premiums on hookers and private jets. Not too auspicious. You want to know the pulse of the people? Look up Urban Dictionary. Now, we can argue all day long about whether the reputation that has survived intact since the 1300s until today is earned and deserved or not. I don't want to spend any time on that question. What definitely preoccupies us at Lemonade and should preoccupy us as an industry is, why does it persist? Insurance is and certainly should be a social good, not a necessary evil. Why, for 700 years, have people been bickering that it's all about taking the monies and not parting with them when the claim comes? And that perception doesn't only mean that people don't want to buy insurance and all these truisms about insurance is sold and not bought and all that kind of stuff. It actually drives economics and behavior. 25% of Americans tell people when surveyed that it's okay to embellish claims. I like to quip that the other 75% were brought up not to admit that kind of thing to strangers. But think about that, 25%. It's very unusual. Usually fraud is people stealing credit cards and hacking in and all that kind of stuff. No, 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 the fraudsters are normative people. It's us guys. We regard ourselves as law-abiding citizens. We abide by the law all the time. And then when it comes to insurance, we let the devil out, and then we go back to being law-abiding citizens. Something about insurance brings out the worst in humanity. And in fact, our chief behavioral officer, Professor Dan Ariely, who spent 10 years researching this, reached the conclusion that if you set out to create a system to bring out the worst in humanity, it would look disturbingly like an insurance company. Just about every facet of what you should not do if you want to bring out the best in humanity is manifest in insurance companies. Now, I want to show you a 2-minute excerpt from a 2-hour documentary that Professor Ariely made. The one thing you need to know, since we're going to jump into the middle of this documentary, is that one of the experiments that he ran involved having people fill out maths questionnaires, doing maths exercises, and then he would have you mark your answers. He'd give you the answers, mark them. You'd come to the front of the hall, declare, I got 7 right. You'd shred the document, and then he'd count out $7. His shredder is doctored, and he can see whether for $1 you're willing to lie or not, and then he can play with different parameters. We're going to see 2 variants of that experiment, and you can see how impactful behavioral economics can be on fraud. Let's watch together.
My name is Dan Ariely, and I'm interested in human behavior. And in the last few years, we've been focusing on dishonesty. As long as we cheat just a little bit, we don't have to pay any price in terms of the image and the way we view ourselves. And we call this the fudge factor. So this is the ability to misbehave and think of ourselves as good people. And you can think about all kinds of ways in which in your own life you have a fudge factor. The speed limit. Maybe it says 55, but are you okay in driving 60? What about cheating a little bit on taxes? What about exaggerating their online dating profile? Across many studies, we find that everything that changes the fudge factor also changes people's ability to be dishonest. There are dozens of elements that can change the magnitude of the fudge factor, and we've been able to observe many of them in the lab. So imagine the same experiment I described earlier. You fill in your sheets, you solve these little problems, you shred the piece of paper, and you come to the experimenter. You tell them how much money you deserve. You tell it in tokens. I solve X problems, I deserve X tokens. So now you pay them in pieces of plastic. They take this piece of plastic, walk 12 feet to the side, and change it for dollars. So when somebody looks you in the eyes and they lie, they don't lie for money, they lie for something else, but that thing becomes money very quickly. What happened? In our experiment, people doubled their cheating.
There you go.
Thank you. We went to UCLA, and we asked about 500 undergrads to try and recall the 10 Commandments. How many of them do you think recalled all 10 Commandments? 0, that's right. By the way, they invented lots of interesting ones. What happened after people tried to recall the 10 Commandments, even if they were unsuccessful? Nobody cheated.
Okay. So Dan's experiment shows, and he's got many variants on this, and tremendous amount of research has gone into this in social sciences, but I just showed you two simple variants. In one, you're asked to recall the 10 Commandments before answering the questions. In another, the money comes only after you convert it from tokens. And these two ridiculously simple steps had dramatic impact on the cheating, right? It brought it down to nothing in one event and doubled it in the other. So the impact on the kind of trustworthiness and the way we behave is easy, in the best sense of the word, to manipulate. In other words, it can be something that we can bring out the worst in people, or if we construct the game differently, you can bring out the best. And I have to say that we don't for a second believe, and I've been called on this a couple of times, so let me be very explicit. I do not think that there are any bad people in insurance, or at least that is not a prevalent problem. The problem, guys, is not the players in our telling, it's the game. We're big believers in game theory. We're big believers in the ability of a certain game to predict outcomes. And in this particular game, the outcome is highly easy to predict. Conflicts of interest and perception of conflicts of interest bring out the worst in people in the ways that I've spoken about in other events, and I won't belabor the point too much. But what this did do for us is it drove us to create a new kind of insurance company. We didn't for a second believe that sprinkling technology, pixie dust style, on top of an existing edifice of a 100-year-old insurance company could affect profound change. It doesn't mean that if you work in one of those edifices, you shouldn't sprinkle technology on it. By all means do. But understand that there's a glass ceiling to how much impact that can have. And for us, rebuilding insurance from the ground up and all the hard work that entailed was in order to be able to create this substrate that I spoke about earlier of social sciences and computer sciences, behavioral economics and AI. And to create a business model where we do not make money in denying claims, where we take a flat fee, stuff that we write about and have spoken about on our website. So a lot of the behavioral economics, all of Dan's research plays a role in the business model, but also artificial intelligence, and I'd like to show you how the interplay between the two, and we really see them as being highly complementary to one another, can hopefully affect meaningful change. So I'll start off with the idea that we take a flat fee and we donate to charities of your designation, whatever's left over, if indeed money is left over. Now, on the one hand, that signals, and signaling is an important part of game theory, it signals a lack of conflict of interest, the idea that we don't pocket that money anyway. It hopefully elicits better behavior in us because our hands are tied. We have no incentive to deny or delay your claim. But I'm hoping that it also brings out better behavior in our customer base. Instead of letting the devil loose when it comes to insurance, what happens when you're met with this screen that reminds you that your claim is not made as against a nameless, faceless, huge conglomerate with whom you feel you have a conflicted relationship, but if you're excessively claiming you're hurting your kid's school, which you designated as your give-back cause. Go back to Dan's research and think about how much that can have a binary effect on our behavior, not so much to bring crooks in line, but to make sure that the folks like us, who account for most of the fraud in the first place, stay in line all along. Time will tell. We're a young company. Data is still gathering. But in the last few weeks, we've had 6 customers return claimed money. We paid them, and they individually, one by one, contacted us. Hey, the laptop turned up. I'd like to return the money. How do I do that? We haven't got such a big book of business. 6 claims in as many weeks is an unusual number to come back, and the old-timers in our company tell us that they hadn't encountered anything like it, so perhaps Dan was onto something. But the other piece is that if you manage to lower the conflict, and if you manage to neutralize any desire to deny or delay claims, that's when AI can kick in. We made a bit of a splash by announcing that we'd paid claims in 3 seconds. We now pay about a quarter to a third of all claims instantaneously. That happens on a substrate or on a basis of a more trusting relationship. These aren't binary outcomes, but a more trusting relationship. And if you do not have the incentive to pay claims instantaneously, and if you don't have an elevated level of trust relative to today's baseline, it's very difficult to offload this to a bot and say, hey, just go and pay the claims. So to us, again, this AI and behavioral economics interplaying is really very key to how we pay our claims. Let me give you an insight into some of the results so far, some of them quantitative, some of them qualitative. The first thing of note is we've really been, this has stopped working. We've really been overwhelmed by the reception by the consumers. Insurance is not something that people tend to get excited about. If people tweet about insurance, it tends to be with expletives and not the kind that you want. And yet we're finding a tremendous amount of sharing, of virality, of word of mouth around what we're doing. And I think that if I try and analyze it for you, it's really a cocktail of three value propositions that are interplaying in a really powerful way. One is value. For renters in the US today, we're able to offer a policy that is dramatically cheaper, oftentimes 70 or 80% cheaper. We've got a blog post explaining how that can be done in the context of insurance. We can't do it across the board, but for entry-level insurance, renters insurance, we can. And suddenly you get to a price point that is an impulse buy. Insurance has never been an impulse buy, but $5 a month, which is our most popular product, people are discovering it, they're buying it. They didn't set out to buy insurance that day, but they end up buying it. The process is seamless, the price works. It's a price of a cup of coffee, as a few of them have told us. It's cheaper than their Spotify, so they go ahead and make the purchase. So the value has been a key one. The values is the other one. So I spoke about avoiding conflicts of interest. I think all of us, and particularly the youngsters, find that values and mission-driven companies speak to them in a way that traditional insurance has a hard time speaking to them. And here, those 700 years of pent-up animosity perhaps help young companies like ours. People want to root for the David versus the Goliath, and that plays and helps us, no doubt. And then the third part is the technology. There's no question. Those of you who have played with the app, get the experience, and understand that insurance can be fun. It can be playful. It may not be something that you want to spend all afternoon doing, but when it surprises you, and at the end of the process, you're like, wow, that was kind of cool, you talk about it. You share it. It surprises you, and explicitly against the backdrop of rather lowered expectations. So again, that helps. And that has translated into significant results, albeit very early. The company is still very young, and I think we can all agree that it takes some years before we really know how an insurer is doing. What you're seeing here is our weekly sales numbers, and you can see that what we've really been experiencing is exponential growth since launch. We launched just over a year ago, so this is basically 1 year of sales. What that translates into is about 70,000 policies in our first year. So still, by traditional standards, a small book of business, but blew away our expectations. We're now selling in 1 month more than we thought we'd sell in 1 year. So for us, this is way ahead of anything that we'd predicted or expected, and we're thrilled with it. I'm going to show you a graph that looks similar, but actually starts coming back to the AI piece as well. And this is something that we haven't spoken about much, policies per human or policies per employee. One of the things that we're finding incredibly powerful and we're tracking pretty religiously is how much we're able to scale the model. How much are we able to use technology instead of people? And in our company, as with many insurtech companies or startup companies in general, technology is not a cost center. It is the company. And when the folks in finance say to me, Daniel, we need another hire in finance because there's a lot of regulatory filings, my answer invariably is, do you need a person in finance or do we need another engineer? And when support says, hey, we're shorthanded, we need another people in support, I say, do we need another support professional or do we need another engineer? And I'll tell you that 9 times out of 10, the answer is we need another engineer. Because regulatory filings or financial reports can be done by bots. Support can be done by bots. Adding jewelry or changing coverage can be done either by the consumer or by bots. And as soon as you think of technology as the core of the company, not a cost center that's building a website for your product, it is truly transformative. What we're seeing already is that we now have about 1,200 policies or customers for every 1 employee that we have. So 70,000 customers or policyholders, less than 60 employees. We think we're going to get to 10,000. My understanding, and we haven't done an exhaustive survey, we just sampled a few of the largest insurance companies. I think the number today is already better than most of the large insurance companies, and the trajectory is pretty compelling. So again, the interplay of technology. And that translates, this scalability translates into geographic scalability. We just launched our 7th state in our first year of operations. We're licensed in 22, we're live in 7. California is by far our largest state. It's one of the largest states in the US. In all of California, north and south, LA, San Diego, San Francisco, Silicon Valley, we have rounded up to the nearest number 0 employees. The closest employee in California is 5 to 6 hours flight to the east in New York, and we're able to really grow and scale in an entirely virtual manner. So the digital platform allows for very rapid deployment and massive scalability. We're launching state after state. When we get our rates and forms and licenses approved, we're usually live within 48 hours and without having to move any people around. And we're using bots in ways that may be less obvious than just looking at our website. So when you onboard with us, Maya, our bot, asks you if you have an existing insurance policy. Maya then cancels the policy for you. Now, that isn't just a front-end form that generates a task for somebody in the back end to do. Actually, no human being does it. Our systems have a database of different insurance companies, how they like to receive cancellations, to what address, what fax machine invariably. And Maya produces the letter, sends it off, and no human beings are involved. And the list goes on how we're able to use AI and bots in our back office functions, not only in our consumer-facing ones. We launched an API a couple of weeks ago. The idea that you can teach a bot to talk to a human is cool. Their native tongue is machine, and they love talking to other bots. And if you can get insurance in 90 seconds when talking to a human, you can do it in 90 milliseconds when you're talking to another machine. So we think a lot of the future is going to go through APIs. Once you're able to generate bindable quotes algorithmically, allowing a machine to talk to a machine and becoming embedded not only on our website and our app, but on a gazillion websites and a gazillion apps is an incredibly powerful thing, and again, bespeaks of scalability. And finally, I think that this kind of an architecture and a digital, natively digital company allows for transformation deep in the insurance product itself. So a few weeks ago, we launched our first foray into this, and this really is just the tip of the iceberg. We launched something that we call Zero Everything. So it costs you a little bit more. You can opt for this when you buy a policy, but you can have zero deductible, full replacement value, and zero rate hikes if you make a claim. You claim that $1,000 laptop. Today, with most insurance policies, you'll end up getting $300 by the time you're done away with the deductibles and the rate hikes and everything else. And you may say to hell with it, and you'll feel cheated and tremendous animosity. And in fact, most fraud in insurance equals the amount of the deductible. So you think you're gaining a lot by adding the deductible. It ends up getting netted out by the fraud oftentimes. But in part, the deductible is there to deal with the fact that claims are so expensive to handle. Small claims are known as nuisance claims. And they're known for that because it cost me $500 to pay you that $500 claim. And therefore, I want to really do away with these small claims. Well, when you've got somebody like AI Jim, our bot, he loves small claims. He doesn't know how to deal with a house that burned to the ground. But your laptop was stolen, he'll deal with that at zero LAE. The LAE in the US in our sector runs between 10 and 12%. 10 to 12% on the dollar in the US goes for the bureaucracy of claims. But the high-frequency, low-severity claims can be handled by bots with tremendous alacrity, and that enables us to start to introduce new kinds of insurance products because those fundamental changes in the economics can drive fundamental changes in the type of coverage, the type of policy, the type of value proposition. And with that, I come back to my opening question. Are we facing a Wikipedia moment in insurance? And frankly, my answer is no. I think that you're not going to see the sudden collapse of any major insurance companies. If you do, it would be a surprise to me. I don't expect this to be a repeat of what happened to Encyclopedia Britannica. But I do think the industry is facing an Amazon moment. So in 1999, Barron's had the cover that said that the idea that Amazon CEO Jeff Bezos has pioneered a new business paradigm is silly. He's just another middleman, and the stock market is beginning to catch on to that. Well, hindsight is a wonderful thing. They were right for a while. When they wrote that article, Amazon stock price was at 62. 2 years to the day later, it was down at 14. So it had lost 80% of its value over the following 2 years. They must have felt pretty smart. They were able to predict that this was a bubble. But of course, we know the story. It's grown 80x since then. And I think the message and the metaphor, the analogy to insurance isn't perfect, but it is telling. The large retailers know this is coming, right? They see it. They gather in conferences such as this. They create innovation departments. They acquire tech startups, and they all create websites with e-commerce. What are they doing wrong? Walmart, huge purchases. Why is it that the shift in value has been so, not sudden, it's 20 years in the making, but so dramatic? And you see that with every cycle that turns, it becomes more and more of a runaway success. And I put it to you that this is very similar to the insurance situation, where the assets become liabilities. So it may be true that that retailers created websites and engaged in e-commerce early, but they still had this albatross around their neck of the old culture, the old installations, the old rent agreements that they had, the obligation, the quarterly results that they still had to meet. So they had the classic innovator's dilemma. And it is almost unprecedented for a company to cannibalize itself, even if it sees the tide coming. That Kodak moment where digital film comes along, Kodak saw that coming. I spent many years at SanDisk, and I used to call that the Kodak moment of the company because it really displaced chemical film. The execs at Kodak saw it coming, but it doesn't matter if you see it coming. Affecting that deeper change and jettisoning everything that you've built over the last 100 years in order to jump ship to a new paradigm is almost unprecedented, almost never ever happens. Might it happen in insurance? Yeah. Conferences like this might just affect change. But I put it to you that if it does, it will be the first time in the history of the world that it has. That wraps my presentation. I really thank you for your attention. Have a great day.